Well,
Just saying.
well, I know, but it's funny is that like the first thing I was going to say to intro us, then it cracks me up, so I can't say it because I was going to say, first of all, welcome to Traders, the Trader's Edge. I am Jim Iuorio. That's Bob Iaccino. Thank you for joining us, you guys. We appreciate the hell out of you being here. The success this show has had is amazing. Remember Bob and I's mission. We've been involved in legacy media for 25 years. We want platforms where we can give our honest opinion without anyone looking over our shoulder like a sponsor or a overzealous producer. And here we are. But the thing I was laughing about is that we literally had a discussion like, we don't ever want this show to turn into two Dagos talking markets. And then I look at the way we're dressed, both of us wearing tight t-shirts. I don't even remember putting on a tight black t-shirt today. I just looked and I had it on. Bobby's got his tattoos. What do we do about that?
In Italian circles, there's never that joke. Did you guys call each other and say what to wear?
Because
you only got like 3 or 4 things. You got velour sweatsuits, right?
Right.
You got a couple of golf shirts. They're usually tight and black. And then you got black t-shirts. You got white t-shirts too, but I'm not wearing a white t-shirt on here. The last time I did, I just got reamed at my misuse of bleach.
Oh yeah, exactly. I thought you
was that Steph Pomboy? I don't remember.
Stephanie. Yeah, exactly.
Steph, yeah, just railed me. She's like, use a little more bleach. And then Cameron Dawson said I was bringing back the deep V. I'm very sensitive, you know.
Yeah, of course you are. Now, normally you guys know we shoot shit and talk a little bit about our market takes before we bring on the guest. This time, why the hell would we do that when we have someone the magnitude of a Katie Stockton? Again, before I bring her in, you guys have watched us on different outlets, media outlets for 20, 25 years. You might think we're full of shit, and you might be right. Sometimes we think we're full of shit, but one thing you cannot deny is somehow through our connections in media, we get outstanding guests. And today we have Katie Stockton, the founder and managing partner of Fair Lead Strategies. She is one of our favorites. I can't wait for this interview. Let's bring her on. Katie, welcome to our show, Dagos Talking Markets.
I was laughing backstage. I think the black tees are good looks, especially for a dark day like today.
Yeah, exactly. Good point. And like I said, like I just went to my closet because I was kind of running a little late and just grabbed a shirt. And I was like, oh, well, here we go.
That's hard.
And grabbed Bob's only shirt. I swear to God, people don't believe. There was somebody, I forget who it was. He's probably watching right now, who said to me, tell the truth, you only have one black t-shirt. And I sent a picture on Twitter of my closet where I've got all those, you know, the felt hangers?
Yeah.
Because I hang out my t-shirts, of course, bicolor. And so the whole left side is black t-shirts, the whole left side. And I probably got, I don't know, 30 of them in a row. Some have pictures on them, most don't. And it just looked like this. It looked like a ridiculous, completely idiot child in black t-shirts.
But it makes life easier. Just grab a black t-shirt and go with it. Yeah. You know, but where are you coming to us from, Katie?
There's a comedian. Let me throw this in. I think it was Louis C.K., maybe, I don't know, somebody, Jerry Seinfeld, did a whole comedy routine about how whenever you see people in the future, they all are wearing the same thing. They have like a uniform.
Yeah.
That's it. We're doing it already.
That means we took over.
Yeah.
I love
it. So, Katie, where are you coming to us from?
Connecticut. So I'm actually in my home office right now. And, you know, we have an office in Greenwich, and it's a nice financial center. I feel like we're able to walk down the street, grab a coffee, which is good.
Do you miss going into Manhattan, or are you glad not to?
You know, I go in enough that I feel like when I go now, it's more on my terms. So I sort of enjoyed that part of it where I get the benefits without some of the day-to-day drawbacks of it. You know, the commute can be a pretty big grind here from Connecticut, as much as, you know, it's always good to be in the office. So we're definitely loving being a little bit closer to home, closer to the family too. So that's good.
That's awesome. Okay. Today, the equity markets got the crap beat out of it. The trigger seemed to be when Jerome Powell gave a speech right next to where I was. I didn't get an invite. Thanks, Jerome. If it was Kudlow, he gives me invites all the time when he speaks there. But anyway, so he basically, it seemed to me that he shrugged and said, yeah, I don't know what the hell's going on either. That didn't seem like a great message for the market. What do you thought?
Market definitely didn't like it. We saw even some gaps down as he was speaking. So it just shows to me like a little bit of a skittishness to the tape that's normal when you have sentiment as bearish as it is. So I don't think it was terribly unhealthy action, but intraday obviously was a bit of a swoon. I'm just looking at the quotes right now. Could have been worse, frankly. The way we're seeing it is that we have short-term momentum is actually having improved, of course, off of the recent low. And our indicators are designed to reduce noise, and they're not really treating today like any big reversal lower, start of a retracement. But anything goes. We are neutral short term, not bullish short term, even though we think the market is more likely to go higher. The reason we're saying neutral is because we're not advocating people buy this relief rally. And so the relief rally, we think it has some room. It has some room based on the overbought, oversold metric short term, has some room to resistance. We're looking at about 57.83 on the SPX. And yet, the risk is always heightened when, even though, we have that improved short-term momentum, the intermediate term momentum is still very much to the downside. So there's enough dueling influences out there that would make us uncomfortable taking, sort of heavy long positions. There are traders who are highly qualified to take advantage of this volatility. And indeed, I think this is a great environment for them, because when you have such wide intraday swings, you can do very well if you're really close to the market and have a real system or methodology.
And Bobby, I think I know your answer to this question too. I'll ask it to Katie. Where did we trade? We traded like 4,800 on the downside. That was the low in the S&P, right around there, whatever. I don't need to be exact for this question. And I know we have a lot of room on the downside, but do you think ultimately the low is in, and this now is just digestion waiting for real fundamental news that could drag us out of this?
Yeah, so the low print, it looks like it was 48.35. We actually, pay more attention to closing prints typically. Some people are like intraday people, were more closing print people. So we didn't see a breakdown below this key level, which is 51.26 to 51.33. That is based on 2 Fibonacci retracement levels that are pretty important. The reason they're important is because if they're broken, for us, it means that we've gone from correction to bear cycle. And we have other reasons to expect that already anyway, right? Whether it's percentage decline or monthly MACD indicators turning negative, there's evidence supporting that. But that's where for us it becomes somewhat official. And also the Fibonacci's, the way they work is if you take out this sort of zone, the 38.2% retracement has been sort of penetrated, and that becomes, or it increases risk to the next big level, which is a 61.8% retracement. And for the S&P 500, that's closer to the 4,500 area. So naturally, this morning that was about 15% below. So you feel like that's enough risk that you'd want to manage through that kind of breakdown. So we're still pretty cautious. I think the next downdraft has the potential to take out that 48.35 because we have weakened long-term momentum. So it's not just a short-term issue. We know that now. It's affected our monthly gauges, and those monthly gauges on relatively new sell signals can stay that way for a year. I'm not saying that the bear cycle lasts a year because there's an inherent lag to these indicators, but it can be somewhat prolonged. So we think we're still, maybe it's not, the first or second inning, but sort of the earlier side.
Katie, from a short-term perspective, everything you know about technical analysis, because obviously I believe that Jim and I, specifically me, are shorter term than you look at things, right? So I look at a lot of, I don't want to say the same things, but similar things. So when I'm looking at, let's say the Qs, for example, I look at the last 5 days since the rally on April 9th, really is kind of sideways consolidation rather than more sort of back and forth volatility, because I look at it versus very recent price action. For the short-term trader, the recent price action means more than the past price action. It all matters, but the more recent, the more relevant. So I look at the actual retracement from, and I use GAN levels, not fib levels. So I look at the actual retracement from the close on April 8th to the high on April 9th. And I also look at closes, and it means downside to me if it closes below the 50%. What's wrong, if anything, with that thesis?
I don't think there's anything wrong with it. I actually think there's no like singular discipline that has all the answers. What I think there's value in is in going back to the same discipline or having a discipline, right?
Having a process, right?
Yeah, having a process, knowing the nuances of those GAN angles, which I'd have no clue about. Using them long enough, I'm quite sure you get some good sense from, when they work, when they don't work, that type of thing. So there's nothing wrong with that. And I do agree that you want to weight the more recent price action. In fact, that's what an indicator like the MACD does, using an exponential moving average of price, right? It's actually rewarding the most recent price action. And we're also in this camp where when we look for support and resistance levels, we're always looking for the most recent level and giving that more weight than something years ago, because it's just the market's memory, right? So the market's memory is very short these days. Everybody has a short attention span too. So I think that the levels that are quite old might be too old. So we're a big believer of focusing on the recent action. And in a way, to your point, the big volatile, like 2-3 days that we saw, since then we've actually seen a little contraction in volatility. You can see it in the VIX, in the VIX, though, when you get those initial spikes, like the big spikes, like we saw up to 60, as much as that's usually indicative of a short-term low, it tends to be followed by a pretty highly volatile environment, right? It like back in 2008, stayed elevated for some time above 50. So you're still getting pretty massive day-to-day swings in that environment.
So I want to ask you just sort of a general question. I think I know how you're going to answer this, but regular viewer of ours and big fan of yours, it's Stock Charts, which is Remo. He wants to know, his name is Remo. I don't know if he wants anyone to know that, but he says, Katie,
now.
right now, Katie, love your work over the years. What is your number one go-to tech indicator? I'll be very happy if I know how you're going to answer this.
Yeah. Now, well, do you want to take a guess?
No, let me see if I can guess how you're going to frame this.
Okay.
It's no one thing.
It's at least 3 is what my guess was going to be. Right.
Okay. Yeah. I mean, I always seem to go with the diplomatic answer, right? But I would say if I had to go to the deserted island, the MACD would probably be it. But as you alluded to, you can't look at that in a vacuum. It'll test okay if you just back test that one indicator. But it's that combined with both the stochastics or DeMark indicators and also support and resistance levels that I think you get the most powerful takeaway. So we always say, okay, well, there's, let's say, 3 categories of indicators. Some people might have something totally different, but this is our perspective, where there's trend following or momentum gauges, there's overbought, oversold metrics, and then there's relative performance metrics. And within those categories, we say if you have 2 indicators that are really your go-tos, that's probably enough. So that way, if you think about collectively, maybe you have 5 or 6 things on your radar. I can imagine having far more than that because it would be pretty dizzying, and then that confirmation bias can get in the way.
So, okay, Bobby and I have been accused of the last 3 years for being gold bugs. That was kind of our conviction trade probably for each of the last couple of years. And I was glad of the moves. All of a sudden, recently, the move's starting to scare the shit out of me a little bit when everything else is getting pummeled. When the U.S. Treasuries were last week, was that last week or this week? What day was it when they sold the crap out of it? The euro rallied, gold rallied. They sold the crap out of bonds. When you see a situation like that, does that add, is that a new ingredient to your calculus on equity markets if there's that much fear that everyone's just running for gold?
It is wild. I just pulled it up and it came right down to the 50-day moving average and discovered support. And it's since bounced, and this is over a matter of days, 12.5%. So it's pretty remarkable what we're seeing from the price of gold. And we've been bullish too. We own a piece of it in our TAC ETF. We've been on board with it just from a momentum perspective, of course, in our work, when it's really hard to find things that have very strong upside momentum across, the globe. You just can't find much of anything. You can find some things that have sort of like long-term turnarounds underway, that type of thing. But this kind of strong upside momentum is hard to find. So it makes gold really stand out. It does reflect bearish sentiment, and I think people are just grateful to have something that is working. So that's exacerbating it. There's of course always political and macro influences that I leave to the experts, but I'll just say if it ain't broke, don't fix it, and kind of stay with that trend. With the sentiment data, we do have bearish extremes, but just like the VIX, which is really a transactional sentiment gauge, once you hit that really extreme bearishness, it takes a while to come out of it in full force. So it's like we often will see like the fear and greed index for one sort of bump around the bottom before it emerges with renewed bullish sentiment, enough bullish sentiment to really pull the market out of its bear cycle. So it makes you perk up. It does signal usually a short-term low, but it's kind of the start of it, not the end of it typically.
And you think, just to add on, so if we had to break it down to sectors, tech led the way up, tech's got to lead the way down. Are you looking, if you are going to try to pick a bottom, and I know that it's a process, it's not just a spot, but are you going to look to tech first as perhaps something that bottoms and starts to head higher?
Yeah, almost always. Anything that's higher beta should lead us out of the sort of cyclical lows, and so that includes a lot of tech, certainly a lot of growth stocks. We usually look for growth to outperform on the way out, and there are ways to try to capture that, right? We like to watch the DeMark indicators for counter trend indications. We also like to watch the relative rotation graphs, which are RRGs, and those will show us over different time frames where the sector rotation is happening. Longer term sector rotation is really defensive, and that's what we're being respectful of in our sort of broader positioning, and that includes our ETF, which is pretty defensive in its sector exposure. But we will be watching as we kind of see other indications of a low in the S&P. We'll start to watch those shorter term ones like a 5-day RRG. And when we start to see tech sort of emerge as an improved sort of setup in relative terms, that it provides opportunity. And that's when you can sort of go back to that exposure that is higher beta and a little bit more opportunistic. And we're not advocating that right now. We did put out a buy recommendation recently on Broadcom. We have a Substack newsletter that we reserved mostly for sort of trading ideas. And that was a pretty brave idea, a little out of character for us, but we know people are eager to try to take advantage of the relief rally, and there are ways to do it. By all means, we'd like to have the support of those DeMark indicators for one on our side. But we're always pretty clear about the inherent risk to that.
So, Luis, can you put the banner up real quick? By the way, this is a quick public service announcement. Tradier is offering 3 months free on the Tradier Pro options trading platform. We have talked to people who've been trading options for a long time, trading options for a short time. There is something for everybody in this. It's 3 months free. There's absolutely no obligation. All you have to do is scan the code. It would be a favor to us to help support the show by doing it. No money out of your pocket. And by the way, Katie, you mentioned your ETF, Bury the Lead. Talk about your ETF for a second. Publicize that as well. Yeah,
so it's called the Fairlead Tactical Sector ETF, and it's really shown its muster in this environment. It's I consider it to be a conservative long-term approach to the equity market through sector rotation. Primarily, we're trying to leverage the best sectors from a long-term momentum perspective and also from a relative strength perspective. But we're doing that via equal weight positions, and therein we don't have a high correlation to the S&P 500. So very low beta, low correlation, equal weight positions, which will only be a disadvantage when technology is that primary source of upside leadership, which is when we say, well, great to still own TAC as a core holding, and then you supplement it with those individual stocks that everybody knows and loves, right? Yep. So it's done great. We now have 3 years of a track record under our belt, beating both of our benchmarks, which are respectively the Russell 1000 equal weight index, and then also a Morningstar benchmark that's kind of an equivalent to a 60-40 type of portfolio. a really good, I'd say, fund for retirees to consider, something that it really won't get them into trouble.
What's the ticker on that, Katie?
TACK.
I have that out there. TACK.
Mm-hmm.
It will make you a banner real quick. So I
That'd be great.
want to do some rapid fire questions. I've got some on Twitter, and then I've got some that have been waiting in the comments. Tim, we will get to you after I do the Twitter ones. Harry, we'll get to you. The first one that came on Twitter before the show even started was by Nathan Dolan, who we had on our other show yesterday. And he said, when sentiment starts to go towards the downside, what kind of things can pull it back?
Oh gosh, I wish I had the answer to that, right? It's usually something that we don't anticipate or we don't already know. It's some kind of upside surprise, and it's coming from typically a macro data point, right, or a political shift. It's not something that technical analysis is going to be able to answer, but technical analysis will allow you to identify that shift, which I think is just as important. So what we want to see is the sentiment data, which is measurable, go from those bearish extremes to actually sort of meaningfully back above what we would consider an oversold threshold. It becomes kind of an oversold buy signal is what we call it. So the readings come below 25% or so for fear and greed for one. And it's when they come back above whatever the impetus is that we pay attention and feel like a little bit more confidence that there's a major low being established.
Isn't that sort of the beauty of technical analysis? I always tell people that technicals are the steering wheel and macro is the gas. And you're just trying to get positioned in the right way, have the car pointing in the right direction when whatever comes in and hits the gas.
Yeah, it's a matter of respecting sort of the current status of the indicators and trends and letting that guide you. It's not a matter of trying to predict where the S&P is at year end.
So M is a fan of the show, and I apologize. A lot of the times I really can't understand what you're trying to ask.
I think English second language for M. I think Japanese.
I'm positive of that. You write the way my dad used to write, but it's she or he. I don't know. But basically, what do you think about? I'm paraphrasing what I think the question is. What do you think about the Russell? Because she put $RTY or he. And what do you think about leveraged loans? I'm not sure that's your specialty, but what do you think about the Russell?
Yeah, so the Russell, it basically entered a cyclical down move. You can't really argue against that. We have a MACD sell signal on the monthly chart, a series of lower highs and lower lows. So that's our framework, right? Within that framework, we do have an oversold condition and indication from the DeMark indicators for 4 weeks of stabilization. And is that something I want to buy? Probably not, because I still think the risk is high with those longer term metrics pointing lower. But 4 weeks of stabilization would certainly be welcome if you have a position that you're thinking about paring back. So I think if you have an existing IWM type of position, then maybe wait to reduce exposure. But I would be in that mindset of reducing exposure, because ultimately I think it does go lower and take out those recent lows. It does have great support. I'm looking at the Russell here, and it has good support around 1712. So it's not terribly far from that, or at least it wasn't terribly far from that. And that's based on our monthly cloud model. In terms of leverage loans, I guess we can kind of address treasury yields and also credit spreads. Credit spreads, I think, are a risk to the market right now. They appear to have established a double bottom formation. This is something my analyst picked up on in March, so before we got that widening in spreads. And I think it is something that hints at a weakened economy. And yields right now are very much range bound, but very choppy. So it feels like a directionless period that's characterized by that uncertainty that we have. So I can't say that's either good or bad necessarily. I do think that we'll see treasuries outperform equities for much of this year, though. So even though they're range bound without an established uptrend or anything of that nature, I still think they have some relative performance improvement that's intriguing.
So can I ask a quick question? You mentioned treasuries too. And when you advise your clients, if you're moving them into treasuries at all, is it strictly about the technicals of revolving around the price, or the absolute yield is attractive, or any sort of fundamental factors that might be influencing treasuries? Is it just technicals?
Yeah, just technicals. And we do that intentionally. One, because it's all we know. Two, no, it's not really all we know, but
of course not. I know what you mean, though. Exactly. Yeah.
So with the yields, that we do look at them independently, and we do that with intention, because our hope, honestly, is that we'll see something that is either very much aligned with what a macro strategist might be saying or thinking, and they have that, okay, great, now we have validation. Or it's something that's completely out of line and makes them think, right? I remember way back when, before the 10-year reached 5%, I said to some macro friends, I said, looks like it could reach 5%. And it was pretty far gone at that point. And they thought I was crazy. They said, well, if that happens, then this could happen and this could happen. The lag time, though, for some of those influences, right, is so long that it almost like didn't have a chance for all those bad things to happen. Do you know what I mean? So we got to 5%, but we didn't stay there very long. And all the implications of that weren't necessarily realized because of the time frame.
Bob? So Tim wants to know, Tim, by the way, how much are they down in the post market? ASML came out with awful numbers today. Can you provide the next support level? Which makes me think he's long. Can you provide the next support level on ASML? Tim's a really good friend personally, as well as being a good friend of the show.
So, yeah, we always look at support levels when we have these reports, right? It's definitely informational. But what I will say is that I wouldn't rely terribly much on the support intraday. So if we have it, I see it having gone out at 634. Does that read right to you all?
That's what I see too.
Okay. And then last print, I don't see it offered much lower, but where do you all have it?
Oh, you mean the aftermarket? Oh, shit.
Yeah. Yeah, let me know. I don't see it, but I could just be missing.
But I see that level that I think is support from, I don't know, about 6 months ago. Let's see real quick. Hold on. Aftermarket is up, Tim. Up $3. I got it right now.
That's what I see too, just 636-ish. But regardless, support will be relevant. But I would encourage people to look at it more on a closing basis, right? So not to panic or something if it goes below a support level intraday in response to news. I'd rather let that be a test, not necessarily a breakdown. So if I look at ASML, really the lows back from 2023, they were aligned with the former high in 2022. So there's this kind of loose area of support in the kind of 592 area, which I would say was just tested successfully last week. That level is also bolstered by the monthly cloud model. And so I would look for ideally more stabilization around there, because the secondary level, if we also reference the cloud model at its lower boundary, if you look at a month or two, it's around, I'd say 535 or so. So we do want to see that initial support level hold. But again, more important that it holds on a closing basis than intraday.
Bobby, do you got the chart up too?
Yeah.
Here's what, again, my licenses are more for futures. I'm not talking about, this could be widgets for me looking at this chart. But I say if it takes out the high from the red wick from like 4 candles ago, which I can't really pinpoint what that is. It looks like it's about in the mid 700s. If it bounces off that support, which I identified just like Katie did, and then it trades back up above that like 750 level, I don't know. To me, it looks like it could be a buy. I mean, broken out of that chart on a closing basis. And I agree with Katie on that, Bob.
Yeah, I mean, 750 is great, but you got your 200-day moving average 772.90 today.
Well, then let's go above that, a close above that, and then strength the next day.
I mean, for me, these trades, I almost put out an NVIDIA buy in our newsletter. For those of you that want to see our newsletter, the link is in my bio, and it's also in Jimmy's pinned tweet. I almost put out a buy on our newsletter platform for NVIDIA, just a scalp based off of a false breakout of a downward sloping channel, which I normally hate those, because my average hold time is about 25, 26 days. So I'm not going to buy a long in a downward sloping channel because it's downward sloping, right? So my target is moving toward my entry every single day. Top of the channel. So just dumb. And I decided against doing it. And this one, it looks the same to me. Like I believe in the long-term viability of these chip stocks. And, I even said I'm meeting a friend of mine tonight who has, he's part of our retirement planning. He's a really good friend, but that's also what he does, to start talking about nibbling at things long-term that I like long-term. And NVIDIA, ASML, even Broadcom is probably going to be on that list. But I just hate this chart. I just hate it.
I mean, it's like buying a downtrend is lower probability.
Yeah.
So I think that's what you're feeling. There's also, if the broader market were to be bottoming, then I understand why people get into that mentality. They want to get close to that major low, because that first move off the big low is usually pretty massive. So I understand the appeal in sort of sourcing these downtrends, but I think it's early for that kind of tailwind. I think right now, maybe a short-term rebound, but pretty difficult for the average investor to take advantage of. So rather than, fight a trend, put a little bit more weight of the evidence in your favor. Let there be an initial support discovery and retest, and then feel better about it.
And I want to point out to you guys watching, that's just the trader in me. And I've been doing this for 31 years. Jimmy, what are you, 32 or 33?
38.
38. Jesus, you aren't old.
I started when I was 9.
He's actually only a few months older. It's like, you look at it from this perspective. The trader in me still wants to do these things. And it takes every ounce of strength I have to not do them. It's crazy, because you're always like, because if you do end up buying somewhere near that low, that snapback is beautiful. I want to get to Harry's question, but it's just one of those things. It's like, I literally thought about it for a long time over the past 6 years. In 31 years, I bought the low and sold the high 4 times.
Right. Which is just
31 years. It's just not something.
It's like maximizing a put or call flight. Just doesn't happen.
And this is your day job. So it's a very good point, because it shows how hard it is.
Yeah. So Harry's question, Luis, if you could, in terms of gold, it looks like central banks are doing the buying. What do your indicators say about institutional or individual investors positioning? If that's something you do, I didn't know that you did.
Probably not. You don't do that, right?
I don't look at the money flows, but listen, if you have big institutions on your side, great, right? Or big governments on your side, as a retail investor, I think that's generally a good thing. And anything that has such deep global liquidity as gold or most FX, most commodities, I think that's it's a little harder to see gaps down or anything of that nature. So I think it's still fairly safe.
And I by the way, I don't think that a ton of individuals are yet really invested in gold outside of our industry. And I run polls on Twitter about that. And a lot of people have very, very little exposure to gold. I've been getting calls from friends in the last week saying, "Hey, should we buy gold?" And I'm like, "Well, you should have called me 3 years ago." But yeah. Okay.
It's return chasing. It's always return chasing.
Always right.
Just today.
By the way, can I ask a quick marital advice question of you, Katie? Don't worry, it's going to be fine. So just 2 days ago, I'm in my kitchen, and my wife's I manage my daughter's 401ks, both of them. And one of them's got 115 grand in it. And my wife says to me, since March 1st, Abby's 401k is down like $3,500. And I'm thinking to myself, yeah, damn right. It sounds terrible. Then she looks at me and goes, "Are you losing your edge?" Now, is this a divorceable comment or no?
I think right now provide that. You just need some charts to support your.
I should have gotten the whiteboard out. But anyway,
3%. That's not bad at all.
It's not bad at all. It's little less than 3%.
Massive value in limiting drawdowns, right? Because you're digging yourself out of a less deep hole. And I
had a lot of gold, right?
If you think about the percentages that you have to, sort of recover when you dig yourself deeper and deeper, I just think it's really compelling. It doesn't mean you won't see your portfolio go down, but as long as it's going down less, you can feel pretty good about that.
Okay, I'll yell at her. I think she's in the shower.
There's another question here from Tim. And Tim, I got to be honest, I'm not sure if I understand the question, so I'll read it to two people that are smarter than me. Well, wait, only Katie, never mind. It says, "I know this is a technical analysis day, but why would NVIDIA sell chips to China against US sanctions if demand was unlimited?" I'm not sure I understand the question. Are they saying that
if I was gonna ask this question, Tim, I'd probably call you and ask you, Tim.
Yeah,
So,
I'm curious if you mean that they said they're going to do that, Tim?
I think they did say something that they were looking for ways to figure this whole thing out. Which, by the way, for a little non-technical interlude, Bobby and I talked about this on the Trade Air Rundown. The fact that China said they're looking for respect and they want an actual envoy appointed to be the point man, to me, I thought that was a friendly volley that was supposed to sound mean and heels being dug in. But I actually think that's a movement closer to the table. So I think I put that on the side of a positive. And just outside of your technical analysis, Katie, do you agree that that sounded like a positive? Just Katie, the person.
I saw the same, and I'd say I probably don't know enough about it. My perception wasn't negative though about it. So sure. Yeah, maybe a not negative is sort of a positive in this world right now.
I'm telling you, having worked at a Chinese institution and a Japanese institution, the respect is the key part of that overture to the White House, because if Trump says anything that is taken as disrespectful, they can't agree to a deal. I think they want to agree to a deal. But if he says something that comes across to them as disrespectful, they're going to have to stand tough and walk out. I don't believe they want to. So I think it's a massive positive. That's why they don't want to talk directly to Trump.
Right.
Or Peter Navarro or whoever is the most disrespectful person. They need somebody who's just going to, bow and say nice things, and then they can come to a deal.
Yeah.
But if it's Trump, that's not likely to happen.
Well, because he doesn't, giving respect is not really what,
he's does like, you guys have been stealing, you've been stealing. It's a big thing. Everybody knows. People have been talking about it.
Bobby's been working on his Trump impersonation. I thought it was pretty good too. Like I wanted to bash him, but it's pretty good.
We're getting there.
Is there any sectors that you look at now, Katie? And I know we talked about gold, so taking any sort of metals out of the equation. Is there any sectors you look at now that are starting to look positive? And I know, keep that in the lens, people, of it's got to be tech or else it's not going to be broad. Do you think there's anything you're looking at now that looks good?
So there are certainly things that look good or better in relative terms, right? So we have to differentiate, because we do a lot of relative work, because we have a lot of advisors, for one, as clients who need to be invested, right? And they can't justify going to a super small equity exposure. But what I will say otherwise, in absolute terms, things are looking less good, right? So we're going from strong trends to less strong trends almost across the board for the sectors. I mean, energy has a big breakdown. We own still in the ETF tech, we have 87+% equity exposure via the sectors, but we're going down still, right? So we just kicked out tech, as you could imagine. We swapped it in with real estate, and this is our models telling us to do this. This is not me saying, it's not discretionary in that way. So we do expect to see more sectors removed from the portfolio, and we'll take that position and put it into risk-off categories like gold, like short-term treasuries, and we'll do that just temporarily, but to manage risk when these sectors are starting to falter or already faltering.
So that's interesting to me, because it actually, I don't know how transparent ETFs are for when they've shifted to things. I'm not quite sure how that mechanism works. But when you look at like an equity sector back test, or you're looking at like regimes, when real estate starts to outperform and technology starts to underperform, that falls in sort of the deflation or the stagflation sort of regimes. So it'd be really interesting to me to see how that goes. Deflation obviously would represent more of a recession. Well, stagflation is its own demon.
Yeah, it's really interesting, because it almost goes back to our point of looking at yields from a technical perspective, but hoping that it makes sense from more of like a macro perspective. And that's very much
the ticker out again. I want people to
TACK, right?
TACK. Yep. And ETFs are actually very transparent. You can see the holdings online within a day of trades being placed. So that's kind of one of the benefits of them for the end user. And we have to post the holdings.
So, it's funny you say that, to some of the clients that I talk to that have like a lot of retail clients that like to trade stocks under $10, which I always try to get them to not do, because data has shown that stocks under $5 are less likely to go to $10. They're more likely to go to $0 than they are to go to $10,
Oh,
which is what I try to get through to people all the time.
penny
But clients will be like, can you show us some stocks under $15? I go to equity, ETF, and small cap fund managers that I like. And I go to the bottom of their holdings and
that's
try and find
interesting.
something they're just getting in.
Oh, that's good. And then that's what's so great these days, because you can access through, the ETFs, the active ETFs, really good managers that might not have been accessible to everyone before. So I think that's another great nature of the product.
When you're
I'm
in real
letting all
estate,
you guys know before Jimmy asks this question. I'm sorry, we've only got about 6 or 7 minutes maximum, probably less, with Katie because she has a hard stop. So Jimmy, go ahead.
oh, which by the way, Bobby, because if you could do me a favor, when we goodbye Katie, because she's got a hard stop, can we break down oil? Because I'm thinking about there's something that I really like that could happen and trigger longs for me in oil. But anyway,
Katie, do you look at oil?
What's that?
Does Katie look at oil?
Katie, do you look at oil?
Yeah, we publish on it on a weekly basis, if not more often.
Oh yeah, let's roll.
Let's do oil.
I mean, there's this like very clean long-term triangle formation on the chart.
Mm-hmm.
You could zoom out and see it weekly or monthly bars. And that's what we've been watching for, I guess, probably a couple of years even. And it finally resolved to the downside, right? So with this move, the lower boundary, which was between about 65 and 67, was penetrated enough to confirm a breakdown. And we're upsetting people right now because the next support is around $45 per barrel in our work. That is not a downside target, but we're not going to fudge some support level. It is what it is. That's the only level we can arrive at. And it's based on the monthly cloud model. My thought is it's probably too aggressive as an objective, but that the breakdown basically treats that triangle formation as a continuation, not a reversal pattern, and suggests that we'll see more downside over the coming months from crude oil. And certainly the stocks seem to be anticipating that.
I certainly think that's what the chart is saying. However, my thesis is that if it clears back, I had it as the 63 to 64, 65 level. If it cleared back above it and rejected those lows, I think it would be like a classic kind of shake and bake, a fake break to the downside. And then I was bleeding in some fundamentals as well. I mean, if you look at that 5-year chart that you were talking about, that massive pattern, it seems like below 60 is where it starts to get a lot of really important forces don't want it to be much lower than that. I know right now the Saudis are pumping extra oil, but Bobby, what do you think of that thesis if it clears it again?
There's the wild card is the relationship between Trump and the Saudis. And I really personally think that's what triggered the Saudis to go ahead and reinstitute production that they had cut as oil was dropping. I've never seen them do that before.
Yeah,
I've never seen them do that before. And it was like, just first week or two of Trump's presidency when they started talking about doing this. And I think they're well aware that you simply cannot drill, baby, drill. It's not a turn on the faucets. There has to be CapEx, which there's been more. They have to hire, they have to tool up, they have to have more leases. They can't just do it on a fundamental basis. Also, they haven't even restarted Keystone. So you still have this sort of transport and refinery issues that come with OPEC pumping that much and us pumping that much. I think it's unavoidable right now to say that demand is you can't credibly say demand is going to bounce, in my view. Hear
me out then, Bob. Okay, because one of the things I think all these different market like currency pairs were responding to the potential for trade wars, and then when the field's been cleared, and this thing was always supposed to be about United States and China. This was like an old Western movie. All the 70 other countries are dead in the dust. The music's playing and the face-off's beginning. But anyway, what are those two things? Those two countries are the most important in that they're the biggest consumers of oil. So the oil market is literally focusing on us two hurting each other's economies. And I think a lot of bad is priced in on that. And this envoy today, this volley today that I thought too, means things could resolve the upside. But I just think it gets a little tough on the downside. And granted, I was there on the negative day too. I saw it as well. But once you get into that was, storage, we know what that was about. Actually, I think
that was nuts.
I think there was something nefarious as shit about that too, by the way. I think someone bought up all the storage in where do we store it off those CME contracts? Anyway, they bought up all storage and then tried to make a run on it. Anyway. Yeah, either way, I don't want to be killed, so I'm not trying to say that to anybody, but I think it gets sticky down there. What other asset do you want to cover for our last thing, Katie? What's important?
Well, I mean, I do get a lot of questions about Bitcoin, so why don't we go there?
Oh, hell yeah. Good.
Yeah.
My thesis is above 8,800. I'm buying it again. What are your thoughts?
So we publish on it weekly as well. And, I believe that it is certainly a risk asset. It doesn't look like gold. It looks more like the equity market. And we're in this mode where we want to find a good entry point, a higher probability entry point, but we have a neutral long-term bias. And that's because we have on the monthly chart an overbought downturn that at least suggests that we're going to be in store for more choppiness longer term. And by longer term, that's sort of like 6 to 12 months for us. So we're being patient, I would say, in identifying that major low. In the interim, I think we have short-term stabilization, just like we do for equities. There's very good support for Bitcoin, just shy of 74,000, which we got pretty close to on the downdraft. And I do use Bitcoin as sort of a day-to-day risk metric where I look at the futures, look at the equity futures, and I look at Bitcoin, and I sort of reconcile that. If Bitcoin's down a whole lot and the futures are down less, well, to me, that's an indication that maybe the futures will worsen. So there's real value in watching Bitcoin, even when you're not involved. But I think that those who are involved are probably just going to sit through maybe more range-bound environment, maybe a slight downtrend channel. But the secular bull trend, just like for equity, should ultimately resume. So if you can be that patient, certainly that should pay off. It just might be a little choppy between here and there.
Bob, I'm going to ask you, because she mentioned something like the fact that isn't without question that Bitcoin trades as a risk asset with a high correlation to the NASDAQ. Yeah. I think that in itself belongs on the negative side of the ledger for Bitcoin. That's never what it was supposed to be. It was supposed to be a dollar hedge. It was supposed to be a non-correlated asset. You agree with that, Bob?
Yeah, that's been my thesis for the last 3 years. Is the last
that's where I got it from.
Yeah, exactly. Maybe the last shoe to drop for Bitcoin to be taken as seriously as I believe it should be taken is for it to lose its correlation to the NASDAQ.
Well, it is actually, if you look at the correlation, it's kind of cyclical, the correlation. Yeah. It keeps resurfacing, I will say. So maybe it's when the markets are a little bit more volatile that people then go back to treating it like the risk asset. So maybe that gives a little bit of a hope that it's divergent over the long term from that.
I want to put one last thing up on the screen because Katie and I had a pre-call and I mentioned to her that we might cuss. And she said, well, I probably won't follow suit, but it doesn't offend me if you do. And Doug came on here and said, it's lucky that decorum is his middle name. And I'm not sure if that's a reference to the fact that we haven't
cussed at all. Katie,
I think you're single. I'm not offended at all.
Yeah,
I know, but you're such a good person that we can do it.
You're so easy to talk to.
No, I know. I'm just trying to prevent my kids from cussing. So I gotta.
I've been there. It didn't work. My older daughter swears like a whatever. We'll talk later. Tell them where they can find you, Katie.
Oh, gosh. Well, easiest is probably actually through our website. So fairleadstrategies.com. There's a contact form. We offer free trials of our research. We have the holdings of the ETF are on fairleadfunds.com. And we're, of course, on Twitter or X and LinkedIn. So come find us.
Okay. Well, thank you, guys. I'm Jim Iuorio. That's Bob Iaccino. This is two Dagos in tight black T-shirts talking about markets. Thank you, guys. That's not really the name of the show. The name of the show is Tradiers, the Trader's Edge. We love Tradiers. So it would be Tradiers, two Dagos talking in tight black T-shirts, whatever. But everything. Remember what our whole thing was, is that we were in legacy media for a long time. We want to operate on platforms where we don't have producers and sponsors looking over our shoulder. You might think our opinions are bullshit, but at least there are honest opinions, and you cannot deny that we get good guests. Thank you guys all for joining us on the Trader's Edge.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.